All right, welcome back to Power Lunch. I'm Dom Chu. It's time now for your Market Navigator. The government shutdown is in its second week, and that means we're still not seeing any kind of economic data come out of the government. But our next guest says one stock in particular could hold the key to unlocking the jobs picture in America and how Wall Street might be feeling about it. So joining me now on set is Lee Munson. He's President and Chief Investment Officer over at Portfolio Wealth Advisors. We usually see you in this monitor right here, but you're actually here in studio, so thanks for being here.
It's a breakout.
All right, it's a breakout. So let's talk about whether or not we are seeing some kinds of stocks in the marketplace that might be acting as a proxy for the jobs market and where Wall Street is expressing a view on what that jobs market might look like.
Right. So first of all, Robert Half International, it's a storied brand. They focus on accountants, finance, a lot of the areas where AI isn't as ingrained for those workers. So if you overlay some basic charts, it's not a chart crime. My analyst took a look at it, and you look at the JOLTs, the job change. It's about job volatility, job churn. Robert Half almost perfectly overlays with this. In a sense, it trades as a proxy for how loose that labor is. Right now, we don't have it. We have what I call the four no's. We've got no hires, no fires, no raises, and nobody moving. So if we get a little loosening up in de-escalation of tariffs, de-escalation where companies know where they stand on trade, and then we start a rate cut cycle that we haven't started yet, but we know in May we're going to have a change of leadership. We know it's coming. You get those two things, all I need is more job volatility. That's how you make money in the stock.
So we're showing this chart right now of Robert Half over the course of the year-to-date period. This stock has halved in value during that time. So if we place that in context with the kind of jobs numbers that we did see prior to the government shutdown, it kind of indicates perhaps a little bit of that story about this idea that the jobs market may be weakening is weakening.
Yes.
So is there any kind of a turn anytime soon?
You know, I think there's going to be because in terms of the actual job market loosening up and getting more people, because the churn is what we need in America. That's where we get innovation. That's where management can really dial in what they need to make more profits. I still think you're about maybe 3 to 6 months away. Again, we need to have that rate cut cycle happen, which hasn't happened yet, and we need to have more visibility on trade. So we all know stocks move 2 to 6 months ahead of the future. So last couple of weeks, you've seen Robert Half sort of come to life. We're going to have earnings this month. And what I'm listening from management specifically is I want to hear them say, we now have management asking more questions. They want to start looking more. They want to start signing contracts. They're starting to get more interest. That's what you need. So when you see Robert Half start to come up and start to play, and people like me who are in that value play want to start buying it, that's when you know you're 2 to 6 months from that labor market churn increasing.
Do you feel as though this particular move by Robert Half is one that we can say more closely in the future will also align with that jobs picture? And we know the historical correlation has been there.
Yes.
You expect that to continue?
I do. As soon as we see that loosening up in the market where management is really okay letting maybe a poor performer go and not hoarding labor and really ready to hire somebody new, especially in that accounting and finance, which is oh so important, that's telling you that profits are there. That's telling you that you need more. You know, the CFO needs more help. You got to count that cash. You need more people to do it. So when you see Robert Half move up, I think that's when you know you have a healthy job market. Because even if you have a recession, this stock will work. But the main thing is we've got to get out of the no hire, no fire zone, or it's going to calcify. We don't want to end up like Europe.
Or maybe even Japan in some instances. All right. So here, speaking of spending, one bonus one before we let you go. If you look at spending, it's not just about the jobs market. It's also about kind of the consumer commercialized market. We're talking about things like advertising, online especially. Take us through your trade for one of these particular moves in the trade desk.
Oh, it's another Liberation Day loser. Down. It's eviscerated. Down half, just like Robert Half. I love trade desk. Everybody's worried that Amazon DSP, which is how they sell ads, is going to eat their lunch. But half of what this company does at Trade Desk is connected TV. That just means watching TV not on your iPhone, not on your tablet, streaming on a television for those younger people who don't know. And with half the revenue there, what's happened is that while we have concerns about Amazon, we have concerns about AI, at the end of the day, there's more and more ads. Because remember, streaming, we're getting more ad-supported streaming from Netflix, from Hulu, from Amazon. So the pie just got huge. So this is my way of playing Ad's not dead. This is my way of saying just because Amazon comes into your space doesn't mean you're toast. It's the only independent, credible place. And if you sell brands, you're going to go to Trade Desk to buy that. You got FIFA coming up. You got a lot of interest in terms of sports. That's where this stock's going to shine.
All right, so you got a lot of macro meets micro plays here on the Trade Desk. And, of course, the first one out there, just taking a look at what's happening with Robert Half. So, Lee Munson, thank you very much for being here. Brian, we're going to send things back over to you.
All right, great stuff, Lee. Dom, thank you very much.